Imagine you did everything right. You went to college, you got a decent job, you saved for years, skipping vacations, driving the same beat-up car, eating out maybe twice a month. You built up what felt like a real down payment, enough to finally buy a starter home. Nothing fancy, just somewhere to call yours. Then you started looking, and the house you could afford 5 years ago, the one on the quiet street with the small yard and the slightly ugly kitchen, now costs $300,000 more than it did. In the monthly payment, it's higher than your rent, which is already too high. So you do the math again, and it still doesn't work. You're not broke, you're not irresponsible, you're just priced out by a market that seems to have completely lost its mind. Here's the thing. The housing market didn't lose its mind. It did exactly what it was designed to do. The problem is that it stopped being designed for you. This is the story of how American homeownership quietly became one of the most financially exclusive clubs in the country, and how it happened so fast that most people didn't realize it until they were already locked out. Let's start with a number: 43. That's the percentage of American renters who spend more than 30% of their income on housing. 30% is the threshold economists have used for decades to define housing cost burdened. Nearly half of all renters in this country are past that line, and a big chunk of them are spending 40, 50, even 60% of their income just to keep a roof over their heads. Meanwhile, the median home price in the United States crossed $400,000. Just sit with that for a second. $400,000. In 2000, it was around $170,000. Even adjusting for general inflation, home prices have risen roughly twice as fast as everything else in the economy. And wages? Wages grew too, just not nearly fast enough to keep up. The average American worker earns about $60,000 a year. To comfortably afford a $400,000 home using the traditional 30% rule, you'd need to earn somewhere around $110,000 annually, and that's assuming a 20% down payment, which right now is $80,000 just to walk through the front door. $80,000. That's more than most Americans have in total savings. So what happened? Was it greed, bad policy, a pandemic nobody saw coming? The answer is yes, all of it. But the story starts long before COVID, long before Zillow, and long before anybody started blaming millennials for killing starter homes by buying too much avocado toast. Go back to 2008. The housing market collapsed. Not dipped, not corrected, collapsed. Trillions of dollars in housing wealth evaporated. Millions of people lost their homes. Entire neighborhoods in Phoenix, Las Vegas, and Detroit turned into ghost streets. Banks nearly brought down the global financial system. You know this story, but here's the part that matters for right now. After the crash, home construction basically stopped. Builders were terrified. Banks stopped lending to developers. The companies that survived the collapse became extremely conservative about what they built and where. For roughly a decade, the United States built significantly fewer homes than it needed. At the same time, something else happened. The Federal Reserve slashed interest rates to historic lows to prop up the economy. Mortgage rates dropped below 4%, then below 3%. For a brief window during the pandemic, you could lock in a 30-year mortgage at around 2.5%. 2.5%. That's historically almost free money. And so buyers flooded in. People who had been renting for years suddenly realized they could afford a mortgage payment that was cheaper than their rent. Demand surged, but supply was still recovering from a decade of underbuilding. And when demand spikes and supply can't keep up, you already know what happens. Prices went vertical. From 2020 to 2022, the median home price in America rose by nearly 40% in just 2 years. 40%! Bidding wars broke out in places nobody expected. Mid-sized cities in the Midwest, suburbs of secondary markets, small mountain towns that nobody outside the state had ever heard of. People were waiving inspections, paying $30,000, $50,000, $100,000 over asking price in cash, sight unseen. It was a mania, and it was being fueled by the cheapest borrowing environment in modern American history. Then the Federal Reserve did what central banks do when inflation gets out of control. It raised rates. Fast. Between March 2022 and mid-2023, the Fed raised the federal funds rate 11 times. Mortgage rates went from around 3% to over 7% in less than 2 years. That is the fastest rate hiking cycle in 4 decades. Here's what that means in real money. On a $400,000 home with a 20% down payment, a 3% mortgage gives you a monthly payment of around $1,300. The same home at 7%? Just over $2,100. Same house, same neighborhood, same everything. Just $800 more every single month for 30 years. That's nearly $10,000 a year in additional interest, just because rates moved. Now, in a normal market, rising rates cool demand, prices drop, and things rebalance. That's how it's supposed to work. And demand did cool dramatically. Mortgage applications fell off a cliff. Home sales slowed to their lowest pace in decades. But prices didn't fall. Not really. And this is where the story gets interesting. And honestly, a little infuriating. There's a phenomenon economists started calling the lock-in effect. And once you understand it, the whole market starts to make a strange, terrible sense. Think about everyone who bought a home between 2020 and 2022 at those magical 2 and 3% rates. They're sitting on the best mortgage they will ever have. If they sell their house and buy a new one, they have to give up that rate and get a new loan at 7%. For most people, that means their monthly payment on a similarly priced home would jump by 50, 60, 70%. So they don't move. Millions of homeowners who might normally have listed their homes, the couple whose kids moved out, the retiree looking to downsize, the family that needs a bigger place, are staying put. Not because they want to, but because the math says they'd be crazy to leave. The result, an already undersupplied market got even tighter. The number of existing homes for sale fell to near historic lows. And when inventory disappears, sellers hold all the cards. Prices stayed elevated even as affordability collapsed. This is the trap. High rates froze supply. Low inventory kept prices high. High prices plus high rates made monthly payments impossible for millions of buyers, and so the market just seized. You have a generation of owners who can't afford to leave and a generation of renters who can't afford to enter, and between them, almost nothing is moving. Now let's talk about who actually is buying homes right now, because it is not who you think. Cash buyers. All cash, no mortgage, no rate-sensitive buyers make up roughly 30 to 35% of all home purchases in some of the country's hottest markets. That is an extraordinary number. In a normal market, cash buyers are the exception. Now, they're almost a third of the competition. Who are they? Wealthy individuals, real estate investors, and increasingly, institutional investors, companies that buy homes not to live in them, but to rent them out. These are firms you may have heard of, like Invitation Homes or American Homes for Rent, and smaller funds and syndicates you've never heard of. Since the 2010s, institutions have quietly purchased hundreds of thousands of single-family homes across the country. Precise numbers are genuinely hard to pin down because disclosure requirements are weak and ownership structures are complex. But in some suburban markets in Atlanta, Phoenix, and Charlotte, investor-owned rentals make up a significant portion of the housing stock. Now, to be fair, the total share of institutional ownership nationally is still a small percentage of overall housing. The data doesn't support the narrative that hedge funds are buying everything. But in specific markets, at specific price points, the starter home, the entry-level house, their presence is disproportionate. They compete in exactly the price range where first-time buyers are trying to get in. And they have one enormous advantage. They're not using a mortgage. So when rates go up, they barely flinch. They have capital, Data and patience. They can wait. They can overbid, and when they win, that house exits the for-sale market and becomes a rental, permanently. What was once a path to ownership becomes a payment to a landlord, month after month, year after year. Let's zoom in on the supply side for a moment, because this is where a quieter, slower disaster has been unfolding. The United States is somewhere between 3 and 7 million homes short of what it needs. Estimates vary depending on who's doing the math, but virtually everyone agrees there's a massive structural shortfall. This isn't a recent problem. It's been building for over a decade. Why aren't builders building more? Some of it is the cost of materials, which spiked during the pandemic and hasn't fully come back down. Some of it is labor. The construction workforce got decimated after 2008 and never fully recovered. Skilled tradespeople are in short supply, and the pipeline of new workers entering construction has been thin. But a lot of it, maybe most of it, is zoning. Single-family zoning is one of the most consequential and least discussed policies in American urban life. In most American cities and suburbs, it is literally illegal to build anything other than a single detached house on most residential land. No duplexes, no small apartment buildings, no townhomes, just houses. This made a certain kind of sense when it was designed decades ago for a different America with different demographics and different ways of living. Today, it functions as a supply constraint with the power of law behind it. Homeowners, who tend to be older, wealthier, and more politically engaged than renters, consistently oppose zoning changes in their neighborhoods. They call it protecting neighborhood character. What it often protects is property values and, frankly, exclusivity. Every city council meeting where a proposed apartment building or mixed-use development gets voted down is a moment where the supply problem gets slightly worse. Those meetings happen thousands of years all across the country, and the math compounds. Here's the part that doesn't get talked about enough. Home ownership in America has never just been about having a place to live. It's been the primary vehicle for building middle-class wealth. The average homeowner has a net worth of roughly $250,000. The average renter, around $10,000. That is not a gap. That is a chasm. For generations, buying a home was how an ordinary American family built something to pass down, a foundation, a retirement fund, a form of stability that renting simply cannot replicate, because rent goes up and equity doesn't exist for tenants. When you lock a generation out of home ownership, you're not just locking them out of a house, you're locking them out of the primary wealth-building mechanism that the entire American middle class was built on. You're creating a two-tiered economy, those who got in and those who didn't, those who build equity every month and those who build their landlord's equity instead. And the timeline matters enormously here. Someone who bought in 2019, before the pandemic surge, is likely seen their home appreciate by $80,000, $90,000, $100,000 or more just by owning, passively, without doing anything except not selling. Someone who was saving to buy in 2021 and got outbid or couldn't make the math work missed that entire wealth event. And in many markets, they're now further behind than they were because prices stayed high, but their savings didn't grow fast enough to keep up. The window opened, and then it closed. For millions of people, seemingly for good. Now here's where people usually expect someone to offer a solution. More supply, reform zoning, bring back lower rates, build more affordable housing, some combination of government programs and market corrections and patient waiting. And maybe those things will help. Some of them are already happening slowly. A handful of states have passed zoning reform bills that allow more density. Some cities are experimenting with accessory dwelling units, which are smaller structures on existing lots. The market does eventually rebalance. It always has. But let's be honest about the timelines. The supply shortfall took 15 years to build. Fixing it will take at minimum another decade of sustained, politically difficult action. Interest rates may come down, and as of late 2024 and into 2025, the Fed has begun cutting, but mortgage rates haven't dropped nearly as fast as buyers hoped, and they're unlikely to return to the pandemic lows anytime soon, if ever. Institutional ownership isn't going away. Zoning reform faces fierce political headwinds in the exact communities where it's most needed. And wages, while growing, are not growing at a pace that makes a $300,000 or $400,000 house affordable for a median income worker without extraordinary financial sacrifice. So what you're left with is this uncomfortable truth. For a significant portion of the population, younger Americans, lower-income families, people in high-cost metros, home ownership has quietly shifted from an expected milestone into something closer to a privilege, something you achieve if you had wealthy parents who could help with the down payment, or if you were lucky enough to buy early, or if you happened to land in a market that the appreciation wave hadn't hit yet. The American dream used to be a thing you could earn. Now, increasingly, it's a thing you inherit. And here's the final thought to sit with. This isn't just a housing problem. Housing costs shape everything. Where people live determines where their kids go to school. It determines how long they commute. It determines how much financial stress they carry into every other decision they make. When housing is unaffordable, people delay having children, skip medical care, stay in jobs they hate because they can't afford the risk of changing, remain in cities or towns that don't serve them because moving somewhere else costs too much. The housing crisis is a cost of living crisis. It's a wealth inequality crisis. It's a generational crisis. And it's a political crisis because the people most harmed by the problem have the least power to fix it, while the people most insulated from the problem have significant interest in keeping things roughly as they are. We built a system that rewards owning property by making property worth more over time. Then we made it harder and harder to get the first piece of property, and now we're surprised that the system produces winners who keep winning and new entrants who can't get in. There's no villain in this story. Not exactly. There's no single person or company or policy you can point to and say, that's the one. It's a system, a set of incentives and structures and historical decisions that accumulated over decades and produced this moment. And the question nobody has a clean answer to is this: what happens to a society when the thing it promised to its middle class, security, stability, a place to call your own, becomes structurally out of reach for a growing portion of that class? We're not going to find out someday. We're already finding out right now.